Hi folks, David Waring here again with InformedTrades.com and today's lesson of the day. In our last lesson we finished up our discussion on money management with a look at one last method for position sizing known as the percent volatility method. If you followed all our lessons up to this point, you should now have a good understanding of the basics of technical analysis, the basics of trading psychology, and the basics of money management. With this in mind, it's now time to start our next series on the basics of fundamental analysis. So let's get started.
Okay, so as I discussed in my very first lesson, there are two ways that traders analyze the markets, which are known as technical analysis and fundamental analysis. As I also mentioned in that lesson, while most people who buy and sell over the short term focus on technical analysis, and most people who buy in the long term focus on fundamental analysis, in my opinion, both technical and fundamental traders or investors can all benefit from at least having an understanding of both types of analysis, even if they prefer one or the other as their primary tool that they use when making their trading decisions. Okay, so while technical analysis focuses solely on the analysis of the historical price action of a financial instrument, fundamental analysis focuses on everything else, including things such as the overall state of the economy, interest rates, production, the earnings of a particular company, and the management of that company if we're talking about stocks. Okay, when analyzing a stock, currency, or commodity using fundamental analysis, there are two basic approaches which one can use, which are known as bottom-up analysis and top-down analysis. Okay, bottom-up analysis very simply means starting with the minute details. If we're talking about a company, think details such as earnings and management and things like this, and then working your way up to the more broad details, such as, you start with the company and the balance sheet and those types of things. Then you have a look at the state of the industry that company is a part of, because obviously if we're looking at, say, an aluminum company and the aluminum industry is doing bad, then that's probably going to affect the earnings and the stock price of the aluminum company that we're looking at. And then you want to look at things like the overall health of the economy and possibly even global effects, such as other countries which are importing and exporting products from this company and those types of things. Obviously, just like if the industry is not doing well in our aluminum company example, if the overall economy is not doing well, then that's probably going to hurt the price of aluminum and the price of this company's stock as well, as an example. Okay, the flip side of that is top-down analysis, and very simply, everything works in reverse with top-down analysis. In top-down analysis, you start with the broad things like the overall health of the economy, and you work your way down to the next level, things such as the industry, and then finally focus on the details. Okay, while there's some debate over which method is best, my personal preference is for the top-down analysis. I feel that it's better to get a sense of overall how things are going and then work your way down into the more details. It's also sort of in line with my view on things like multi-time frame analysis from a technical standpoint, if you remember that lesson. But anyway, since my personal preference is for this, and by starting with top-down analysis, we can look at things that apply to all markets and not just the stock market. This is what we're going to start with. Okay, so the first thing that it's important to understand from a top-down standpoint is what the economic situation is and how it affects the financial instrument that you're trading. Okay, as I'm based in the U.S. and the U.S. is the world's largest economy, the U.S. economy is what I'm going to focus on. However, the things that I discuss here apply in a broad sense to almost any economy, and when we begin to discuss the foreign exchange market in later lessons, I'm going to go into specific details of the other major economies and emerging economies from around the world as well. Okay, but according to Investopedia.com, the definition of an economy is the large set of interrelated economic production and consumption activities which aid in determining determining how scarce resources are allocated. Okay, the economy encompasses everything relating to the production and consumption of goods and services in an area. Okay, so people often refer to the U.S. economy as a capitalist or free market economy. A capitalist or free market economy, in its most basic sense, is one in which the production and distribution of goods and services in that economy is done primarily by private or non-government companies, and the price for those goods is set by the free market. In other words, the companies that produce those goods and the consumers that buy those, the interaction between those two things is what ultimately determines price. Okay. This is in contrast to a socialist or planned economy where production and distribution of goods and services, as well as the pricing of those goods and services, is handled by the government. Okay, while as I state here, most people refer to the U.S. economy as a capitalist economy, it is really more of a blended economy, as are most economies around the world, as the government does handle some things on behalf of the population here, such as the military, road building, education, and other things. Okay. So why is this important for the trader to know? Okay, the first thing I want to say here is I'm sure there's lots of people out there that have studied capitalism and socialism and know a lot more about it than I do, and I'm not interested or I'm not looking at getting into an economic or a just an academic debate about it. What I really care about and what I'm interested in is how it affects the markets and how it affects trading. Okay, so I'm not meaning to offend anybody here, but in a general sense, moves towards capitalism are seen as pro-business and pro-growth. So whenever there's talk of, or whenever you see an economy or things, policies, and those types of things that are seen as capitalistic ideas or moves towards capitalism, this is going to equal normally market rallies, all other things being equal. Okay, and similarly, moves away from capitalism are considered normally anti-business and anti-growth by the market. So whenever you see these types of things in an economy, you're going to see market declines or market sell-offs. Okay, so that's how it applies to trading. All right, so that's our lesson for today. In tomorrow's lesson, we're going to take a look at take a deeper look into the different parts of the U.S. economy and what makes it tick. So we hope to see you in that lesson. As always, if you have any questions or comments, please feel free to leave them in the comments section below. And good luck with your trading.